Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, I think markets have heaved a collective sigh of relief after what's been an important set of economic data in the US last week, and not the least, of course, coming from the April jobs numbers, retail sales data, and of course the key CPI inflation number. Now, all of this, of course, music to the market's ears, with US equities breaking to a record high following the release of this data. Now, what do we make of that data collectively, and what's it telling us about the long-term trend? To discuss this and more, I'm joined by Raymond Cheng, our CIO for North Asia. So, welcome, Raymond. Thanks for joining us today. A very macro-heavy week. What's your assessment of the data and the investment implications?
Thanks, Manpreet. The headline inflation in April slowed more than expected, ending 3 consecutive months of upward surprises. The core inflation also slowed, which is encouraging news. Admittedly, the latest prints do not give an all-clear signal because shelter inflation remains quite elevated. But auto insurance and medical services that had driven the Q1 inflation resurgence did resume their downward trajectory, which helps ease market concerns about another Fed rate hike. As Fed Chair Powell said, the latest inflation data was a step in the right direction towards Fed rate cuts later in the year. The markets have almost fully priced 50 basis points of Fed rate cuts by the end of this year, which is now consistent with our base case scenario, with the first 25 basis point cut expected in September. Now, we see a window for the not too hot, not too cold Goldilocks economic regime to support risk assets in the coming months. Now, technical indicators also remain supportive, with solid momentum and low volatility, especially in the US and Europe. We expect US bond yields to stay range-bound over the next 1 to 3 months, with the emerging macroeconomic landscape reflecting the Goldilocks regime. This regime is typically positive for equities and other risk assets, especially rate-sensitive tech and communication services equity sectors. The lower U.S. bond yields and improving economic growth outlook for all the other ex-U.S. economies are also positive for emerging market U.S. dollar bonds. Now, we upgraded these EM U.S. dollar bonds to overweight back in April. There are 2 key economic signposts I would suggest we watch out closely to assess if there's any shift from the Goldilocks regime. The first one is business confidence indicators, PMI, that will be released next week. U.S. manufacturing activity was on the verge of contracting again in April, while the much larger services sector is slowing. Now, we'll pay particular attention to the new orders and employment components for any signs of sustained weakness. The second signpost is the U.S. higher frequency job market indicators, such as weekly jobless claims. Last week, initial and continuous claims did rise above the levels that had historically led to U.S. unemployment rate rising above 4%. A sustainable rise in the unemployment rate above 4% would trigger several time-tested recession signals. Now, also do note U.S. bond yields are likely to flag some change in the economic regime, so we should watch out for any trends. Now, if the 2-year bond yield breaks about 5% decisively, accompanied by a drop in equities, this would imply a return to the year 2022 stagflation regime. Now, we see low probability of this scenario in absence of an energy supply shock. Meanwhile, also on the negative end of the spectrum, if a decisive fall in the US 10-year bond yield below December's low of around 3.8% is accompanied by a slump in equities, this would likely signal risk of a shift towards a recessionary or hard landing regime. Now, this would likely be accompanied by a sharp rise in unemployment. Now, on the other hand, any decisive rise in the US 2-year bond yield above the 5% level, accompanied by a rise in equities, would likely signal a shift towards a reflationary regime, or what we call no landing. This would likely be positive for equities. The strong US Q1 corporate earnings, which have led consensus to raise full year 2024 and 25 earnings estimates to 10.4% and 14% respectively, supports this thesis.
Thanks, Raymond, for that very comprehensive overview. Let's turn that point of earnings because we've made quite a bit of progress along the US and European earnings season. What should investors make of the data?
The US earnings season is largely complete. By now, 92% of the S&P 500 companies reported results per LSEG IBES. A total of 77% of these reporting companies beat earnings expectations above the long-term beat average run rate of 66%. Strength has been quite broad-based, with all sectors surprising positively. The Q1 year-on-year earnings growth expectation has gone up to 7.4% from 5.1% back in early April. More notably, full-year consensus earnings growth expectations have been revised up as well, from 9.9% to 10.4% for 2024, and from 13.7% to 14% for 2025. We expect earnings to drive US equities to outperform global equities over the next 6 to 12 months. Now, Europe has also delivered a strong earnings season, albeit lesser than the US. A total of 74% of the stock 600 companies have reported Q1 results, of which 61% beat earnings expectations, above the typical beat rate of 54%. The 8 out of 10 sectors did deliver a positive earnings surprise, and Q1 earnings are expected to fall now just 5.4% versus the negative 11% expectation back in early April. Consensus full-year earnings growth expectations in this year, 2024, have nudged up to 4.7% from 4.1%. Now, although Europe has performed quite well in recent months, we continue to remain cautious given the relatively weaker growth outlook in the region. We expect Euro area equities to underperform global equities over the next 6 to 12 months.
Okay, let's maybe move to China. We've seen equity markets, of course, hold up quite well despite all the talk about US tariffs. And we've heard of a number of measures in the bond market as well. What's your view of all of these events and what they mean for Chinese equity markets?
Yep. China's Ministry of Finance announced the issuance of the ultra long-term special central government bonds, with a plan to issue 1 trillion yuan over the next 7 months. Now, this came on the heels of the Politburo meeting that was committed to front-loading the sale of these government bonds during the April meeting. The timing of this debt is likely intended to offset the impact of credit contraction resulting from a slump in Q1 bond issuance. The proceeds from these special central government bonds will likely be used for infrastructure investments that would be supportive of growth. There are concerns that the influx in bond supply could strain liquidity, but we do believe that should be manageable given the long issuance time frame and ready state buyers. Now, as for property measures, authorities are reportedly considering a proposal for local governments to buy excess home inventories. The execution will likely be quite challenging in our view, given unsold home oversupply is still quite severe at the current pace of sales, particularly in the lower tier cities. Also, I would be skeptical about the local government funding source availability, given these governments are unable to sell land these days. Now, while this helps support risk sentiment in the near term, it's unlikely to be a game changer for either China equities or Asia US dollar bond outlook in the long term. Now, you also mentioned the US tariff imposition onto China imports. Specifically, the US imposed higher tariffs on $18 billion US dollars worth of imports from China, including solar cells, EVs, and EV batteries. The tariff rates would rise to 50%, 100%, and 25%, respectively. The direct impact to the related Chinese companies should be limited because based on the 2023 Chinese exports data, these exported goods account for a very small portion coming from the US. But we do believe this could be the beginning of more to come in terms of the US-China tensions intensifying as we approach the November US presidential election. Also, we need to watch out if Europe will follow suit on these tariff policies, as they are a much more significant importer of the aforementioned Chinese goods. Therefore, we remain neutral China equities 6 to 12 months out.
All right. Well, I think we're just about out of time, so we bring the conversation to close there. Thanks, Raymond, of course, for taking the time to join us once again. If I can just summarize the key takeaways from a macro perspective, clearly a couple of data points to watch quite closely in the coming months, but for now, setting a very positive backdrop for risky assets. Second, of course, earnings very clearly supporting our overweight preference for U.S. equities but a little bit more caution and our underweight view on Euro area equities. And finally, on China, a lot of positivity short term, but longer run, we need to be a little bit more cautious as we approach the U.S. presidential election, hence our neutral view. So, thanks very much, listeners, for taking the time to log in and have a listen today. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.